Wall Street ended yesterday nearly flat, with all three major indexes moving less than 0.05%. The Nasdaq closed at 25,820.14, the S&P 500 at 7,440.43, and the Dow at 52,182.74. But pre-market futures are pointing to a modest pullback today, with Nasdaq futures down 0.37%, S&P futures down 0.13%, and Dow futures down 0.09%, signaling cautious sentiment ahead of the open. There were no single-day moves exceeding 8% in either direction among individual stocks yesterday. Tech heavyweights showed mixed performance. Tesla edged up 0.69%, Nvidia slipped 0.08%, and the Bitcoin ETF gained just 0.21%, all within normal trading ranges. Now let us look at the global macro picture. The 10-year Treasury yield closed at 4.39%, up 0.37% from the previous day. This rise was mainly driven by higher than expected inflation in Europe, with the Eurozone June CPI coming in at 2.8% year-over-year versus the expected 2.5%, which dampened expectations for a rate cut by the European Central Bank and indirectly pushed up global long-term rates. The VIX Volatility Index stood at 17.64, well within the normal 15 to 25 range, indicating cautious sentiment but far from panic. The dollar index was essentially flat at 101.35, with the dollar remaining weak, which is a positive signal for emerging markets and commodities, but sustainability depends on tonight's US ADP employment data. WTI crude oil rose 1.64% to $71.34 a barrel, marking 3 consecutive days of gains, supported by improved demand expectations following China's rate cut and geopolitical premiums in the Middle East. Spot gold broke through the $4,000 threshold, closing at $4,031 an ounce, up 1.02%, lifted by a weak dollar and European inflation data. The bottom line is that global markets are not uniformly risk-on or risk-off, but structurally divided. A weak dollar and rising gold point to continued safe haven allocation, while a low VIX and rising crude suggest support for risk assets. The overall picture is active defense with selective offense. If the VIX breaks above 20 in the next 24 hours, the market could shift from structural divergence to full-scale risk aversion. Turning to China, the onshore yuan closed at 6.7748 and the offshore yuan at 6.7922, both appreciating slightly, marking 3 consecutive days of strength against the dollar. This is linked to improved risk appetite after the People's Bank of China cut rates, and it helps ease foreign capital outflows from the shares, though domestic funds are expected to dominate today. On the trade front, the Biden administration issued final rules restricting AI chip exports to China, expanding the scope to near computing power chips, effective in 60 days. Meanwhile, China's Ministry of Commerce announced export controls on rare earth-related items including tungsten, tellurium, and bismuth, effective July 1, creating a standoff of U.S. controls on AI chips versus China's controls on rare earths. Today, we expect the shares to open flat or slightly lower, with tech pressured by the new chip rules but resource stocks boosted by rare earth controls, leading to a divergent session. For the A-share market specifically, the Shanghai Composite is likely to trade in a range between 4,050 and 4,120 points today. The previously strong tech sector, particularly AI and semiconductors, will face headwinds from the U.S. chip rules, but defensive sectors like rare earths and power utilities should offset the downside. The Chi-Next Index, with its heavier tech weighting, faces more pronounced pullback risk. If the Shanghai Composite breaks below 4,050 and stays there for 15 minutes, the outlook would shift from range-bound to weak. The most certain opportunity today is in China's rare earth and strategic resource sector, as the export controls take effect July 1, creating a supply constraint-driven event trade. Power utilities also offer defensive appeal, with capital likely rotating into this area as tech comes under pressure. The biggest risk lies in high-valuation AI computing and semiconductor hardware stocks, as the new U.S. chip rules directly impact global supply chains and will weigh on sentiment, even though domestic substitution narratives remain valid long-term. Chasing AI stocks today is not advisable. Northbound capital is more likely to see net outflows today, given the pre-market decline in U.S. futures, limited yuan appreciation, and the chip rule headwind for large-cap tech stocks. Watch for whether net outflows exceed 15 billion yuan in the first 30 minutes of trading. Here is our core judgment for the day: a weak dollar lifts resources and gold, but tech restrictions pressure AI, leaving us shares to seek structural opportunities within a defensive posture. Our probability assessment is 25% for an up day, 55% for a range-bound session, and 20% for a down day.